This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Pippa back on the show. Now, let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Pippa's picture saying, looking for the downloads. Now, Eric, let's cover crude oil, starting with the EIA inventory.
EIA printed builds across the board, with crude oil gaining 2.1 million barrels, Cushing, Oklahoma gaining 522,000 barrels, gasoline building 412,000 barrels, distillates building a massive 2.9 million barrels for a net petroleum build of 5.5 million barrels, with U.S. production holding steady at 13.5 million barrels. We tested the 100-day moving average and 200-month resistance on Wednesday with the dollar index shooting much higher. Of course, that's bearish on crude oil. At the same time, we have to consider what policy implications will be, what's going to happen with OPEC Plus and so forth in a Trump presidency. I think it's a wait and see as far as what happens next here in this oil market. I'm still flat crude oil futures and focused on other markets.
Yeah, Eric, I'm in the camp of this being a basing formation, largely because of the reaction function. What you have is all the fundamental reasons why oil is negative and could even potentially go lower. And then when these catalysts come about, oil starts lower, but then almost immediately gets bid and you see a rally that comes right back into the trade range, creating what is a bigger fair value zone. The way I look at this is that it will take a new bearish catalyst to break that level lower. At this moment, it seems that this is an area where oil is settling in. That doesn't make it immediately bullish. It's simply a level where the downside risk is probably marginal, and you're going to see a lot more of choppy price action here as it bounces around within a trade range. Now let's move on to the equity markets. What are your thoughts here, Eric?
The initial reaction to the election result was clearly positive. So now the question is whether the rally can be sustained or if this is going to turn into the sell the news event. Now, so far, we've already had what's I think is the biggest post-election day stock market rally in history. So it seems like the momentum is pretty strong. Can this rally be sustained? I'm not sure. Patrick, what do you think?
Well, Eric, the way I look at this is that we had massive anxiety going into these elections with so many people worried that this could lead to some crazy outcomes. And when the market got clarity as to the outcome and decisive clarity, then the S&P futures reacted bullishly to this and now has created an environment where all of that anxiety now is leading to everyone making sure that they want to be positioned the way they do based upon this new information. And so from a flows perspective, I think the S&P 500 and the rest of the equity markets could have some short-term tailwind as everyone needs to reposition in this post-election period. But the question is that after we have these flows settle in, the bigger question is that what will the market backdrop look like in the months to come? Because ultimately, when Trump comes to power and how long it will take him to implement his policies, we could be talking about the second and even third quarters of next year, which basically means these equity markets are going to have to trade on the fundamentals and macroeconomic data that starts to emerge going into the tail end of the year and into the first quarter of next year. And so there could be room for a lot of volatility later, but most likely here, there's going to be this little party in the equity markets for at least another week as markets are just going to need to absorb all of this new information. On page 4, I have the chart of the volatility index, and one of those tailwinds is the fact that the volatility was able to come right back down to the bottom end of its second and third quarter lows, largely because election premium can now have been drawn out of the market. Now we're down at a VIX around 15. That immediately creates a tailwind for vol adjusting funds that create some of these flows that will contribute on the short term to that upside. But what really want to highlight is on page 5, where we look at the small caps. And the small caps have been a massive underperformer for many years, particularly when you look at it as a factor against the NASDAQ. And what we had yesterday was an explosive rally in the small caps, up 6% in one go, as the idea of tariffs and the protection of these kind of smaller companies will become a priority under the Trump administration. The bigger question is, was this a one-time repricing, or will we see a brand new trend where the Russell on a relative basis will continue to outperform some of these other markets? Is one of the things that I think I'm going to continue to focus on in the weeks and months to come. All right, let's move on and talk this dollar. What are your thoughts here, Eric?
Well, we were starting to see signs of what looked like a topping pattern where we topped out just above 104, which had been a key technical level on the Dixie for years. Looked like the market was going to roll over then, but boy, the Trump win really rocked the dollar much higher, closing Wednesday above 105 after testing almost 105.5 mid-session. Now the question is how long this rally can be sustained, and I think it's going to take a few days for the market to shake out all of the consequences and knock-on effects of this election victory. Also, at least as of this recording, we don't know for certain what the House of Representatives outcome is going to be, whether this is a full Republican sweep or if they just got the White House and the Senate. So we'll see what happens.
Well, clearly a strong dollar regime is going to be coming in, and we're a stone throw away from the year highs. We could easily be up at 106, but what's more interesting to me is where this move is happening. Sure, we saw strengthening of the dollar against the CAD and against the yen, but really the big move was against the euro, and this is the bigger question for me is that will there be a bigger move coming against that euro? Will we see the euro materially start to break down against the US dollar, because that's where the real currency moves can get underway. And so that's the area where I think the focus really has to be as we move forward. Now let's talk gold, Eric.
Quite a few pundits, including our friends over at Saxo Bank, had predicted a massive Trump win would mean a massive gold rally. As I said several weeks ago here on MacroVoices, I think people may have been allowing their political biases to influence their trading views. Now, there's certainly a correlation in that people who like Trump are often the same people that like gold. But it makes no sense to assume that your favorite asset class is going to outperform just because your political candidate happens to have won the election. What I think most people are forgetting is that gold's biggest competitor as a safe haven, independent of the financial system kind of risk asset or hedge against the world going to shit is Bitcoin. Well, until now, there's been a lot of reservation in the institutional community for good reason about betting on a privately minted cryptocurrency, which by its very design exists for the purpose of competing with and displacing government-issued money. But President-elect Trump is clearly going to support Bitcoin and oppose any anti-Bitcoin legislation. That means that the biggest reason to favor gold over Bitcoin may have just been eliminated. Now, personally, I don't think President-elect Trump has a particularly strong understanding of the risks inherent to government endorsing a currency system that was designed to defeat government's monopoly on coining money. But what matters is how policy around Bitcoin will evolve. And as the market has already shown us, Trump's landslide victory is more Bitcoin bullish than gold bullish.
Well, in terms of gold, Eric, I'm trying to keep it much more simple. The way I look at this is that we had basically huge euphoria toward gold. There was simply nobody bearish. Everybody was long. We were overextended on the upside. And at some point, some sort of a correction needed to happen. And so happens that the election triggered some sort of a sell event. The bigger question is this just a short-term correction that is going to be typically bought on dip, which is what we've seen over and over again all year? Or are we going to start one of those multi-month corrective mean reversions that see gold maybe head back down to 2,500? Now, that is something that I think has a realistic chance of happening. It's not because gold isn't bullish in the bigger picture. I still in the view that gold's going way north of 3,000 on the upside, but it does it in a natural ebb and flow movement. And whenever we reach these very overbought states, gold has typically gone into these multi-month periods of consolidation and just absorbing the move. And it's very likely we've begun one of these, and it's more likely that we're going to have to wait until the first quarter of next year to get the next really big bullish impulse. Now, Eric, I wanted to move on to uranium, and I have the chart of that Sprott Physical Uranium Trust. It was trading at net asset value, and when we saw the U308 start dropping down towards $77, suddenly not only did this get hit by a drop in spot prices, but also it started trading again at a discount to that net asset value, which made the drop a little bit more volatile. Overall, I don't see the thesis changing at all, but we're clearly not in a bull phase on the actual spot prices of uranium itself. Now, the charts on uranium equities have been behaving way better. It'll be interesting to see when will this translate to the movement of the underlying commodity. And the last thing I wanted to touch on is that 10-year Treasury yield, which clearly jumped on the post-election results. Now, we are nowhere near those March, April highs that we saw in the summer. But, here we are going into an FOMC meeting with a clear rate cut cycle going, and some very prominent investors such as Stanley Druckenmiller clearly short long-term bonds. And it'll be interesting to see whether or not this can make it all the way back to those March, April highs. And more importantly, when does the stock market start to care? Because right now the markets are behaving like everything is super bullish, but clearly higher interest rates at some point are going to start to impact the broader markets.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.